to introduce the RPL spectrum. In September 2014, RPL acquired MBL. However, in June 2015, an article was published in a medical journal about a new theory that could result in MBL's medical textbooks becoming obsolete. In the year 2015, RPL decided to invest in a new IT system that would fully computerize and integrate all the current accounting processes across the organization, including integration into the general ledger system. Besides that, William Jackson was appointed the new CEO of RPL in January 2015. A component of William's remuneration package is a performance bonus based on RPL achieving an annual growth of 10% in total revenue and 10% in net profit after tax. During 2015, RPL has entered into $7.5 million loan from China Finance. The loan has debt covenants requiring RPL to maintain a current ratio of at least 1.5 and a debt to equity of less than 1. Failure to maintain this key financial ratio under the Subsea 5 benchmark would result in China Finance having the right to recall the loan.
Now I'm going to introduce the key auditing concepts. The inherent risk means that without regard to the internal control structure, the effect of the in-year or objective factor may misstate the transition, account balance, or the whole financial report. The factors which affect the inherent risk are not only the account and the financial report of the company, but also the whole system of management and the objective environment. Risk of material misstatement at the financial report level refers to the risk that's related to the whole financial report and may affect many assertions. Fraud is an act of one or more individuals or parties trying to obtain unjust benefit. The risk of fraud mainly refers to that there is a fraudulent behavior in the company. Fraudulent financial reporting is intentional misstatement or omissions of amounts or disclosures in the financial report to deceive financial report users.
Inherent risk is the susceptibility of an assertion to a misstatement that could be material, either individually or when aggregate with other misstatements, assuming that there were no related internal control. A new theory has been published which could result that MBL's medical textbook becoming obsolete. MBL is just acquired by RPL in this financial year, and the most valuable asset is its copyright of medical textbook. If this new theory is valid, the copyright acquired from MBL needs to be written down by a large amount due to impairment loss. Also, sales of medical textbook could be refunded. As a result, there is a risk that intangible asset and the profit might be overstated. RPL has introduced a new IT system to computerize and integrate all the current accounting processes across the organization in this year. Because of the excess pressure by the board, staffs do not have enough time to get familiar with the new system. Also, the IT manager has already found that several transactions had been recorded in the wrong period. As the new system was installed just before the financial year end and staffs were lack of experience for new system, there might be more mistakes. Therefore, there is a risk that the year-end balance might not be fairly stated.
Hi, I am Jieling. Now, I will explain the two key fraud risk factors relating to misstatements arising from fraudulent financial reporting. The first key fraud risk factor is remuneration package. The CEO, William Jackson, his bonus linked to the achievement of two key performance indicators, which are total revenue and net profit after tax. It creates an incentive for fraudulent financial reporting in relation to sales and net profit, so that William can achieve his bonus. It also creates high chance that William will have controlling interest in the end. Second key fraud risk factor is pressure to meet financial targets. RPL entered into 7.5 million loan from Dream Finance. The loan has debt covenants requiring RPL to maintain a current ratio at least 1.5 and debt to equity of less than 1. Failure to maintain this key financial ratio will result in Dream Finance having the right to recall the loan. It creates an incentive to manipulate figures affecting these two ratios to ensure the loan covenants are not breached. It poses difficult sustain over phone questions when there is significant, unusual, or highly complex transaction. When there is pressure from outsiders to report certain financial results or to meet balance sheet goals to qualify for debt financing, there is a high risk of financial reporting fraud.
Now I want to talk about how the risk factors affect the conduct of the audit. Auditor must consider risk of fraud in revenue recognition and the possibility of management override of control. Identify fraud risk factors and the auditor's response to them should be documented and addressed specifically in the design of audit procedure. Audit should be planned to obtain reasonable assurance that the financial report is free from material misstatement due to fraud or error. Auditor enter into reasonable assurance engagement to reduce the audit risk to an acceptably lower level, to more substantive audit approved to correct sufficient appropriate evidence. Auditor must exercise reasonable care and skill and maintain an attitude of professional skepticism. Auditor must be open-minded to be added the conditions which may indicate possible misstatement due to error and fraud. For example, pay more attention management's practice and conduct to prevent the risk of management override of controls. Auditor must have sufficient knowledge, experience, and training to identify fraud and initiate appropriate actions. When planning the audit, auditor need to consider risk or material misstatement in financial report before procedures. Discuss with other members of the audit team the risk or material misstatement to exchange of view and consultation, and make more extensive inquiry of management. Auditors have a duty to obtain legal advice and report fraud of any suspicions probably during the course of normal, careful gathering of evidence, even though the fraud may not have a material impact on financial report. Auditor must report to a stable senior level within the organization. Report can be made to the board of directors or audit committee. Before reporting any fraud or illegal act to the party, auditors should perform sufficient audit procedures to verify the accuracy of the facts that are to be disclosed.
Created using Powtoon.